Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to look at irrecoverable debts and allowances, or what is popularly known as bad debts and provisions. That is what we are going to look at. Now, we've already looked at that in our video for adjustments for final accounts, okay? But over here, what we are going to do is that we want to try and understand how to do the double entry for bad debts or irrecoverable debts, and then the provisions for doubtful debt, what we now call allowances for receivables. That is what we are going to do. Now, before we begin, I would want you to understand that the bad debt is what we call irrecoverable debt. Okay, bad debt is called irrecoverable debt, and then what we call provisions is now called allowances. Okay, in a professional setting. Now, I'm going to use your normal language to explain to you. So, permit me to be saying more of bad debts and then the provisions. But then that will be for the sake of your understanding, because that is what most of us have been familiar with for a long time. But then, notwithstanding, you should understand that when you see irrecoverable debts, we are talking about bad debts. When you see allowances for receivables, we are talking about provision for doubtful debts. Okay, so this is it. We are going to look at bad debts or recoverable debts and then provisions that are made against that in case a debtor does not pay. Now, take note that we have grown in accounting. We have moved forward from calling debtors as our assets. Okay, so we don't call debtors as assets anymore, but we rather call receivables as assets. And this is the difference. There is a difference between a debtor and then receivables. Okay, so a debtor or debtors is a name that is given to the group of people that are owing you, the company. So if someone is owing you, the person is your debtor. So a debtor is the person or the organization that is owing you. That is the debtor. And then receivables refers to the amount of money that is due from that person, called the debtor. So how much the person is owing you, or your money that is with the person, is what we call receivables. Let us try and get this. The person that is owing you and the money that the person is owing you, which one is your asset? Which one belongs to you? Of course, you don't own the human being. It is your money that is there that is your asset, not the person. And that is why we are saying that it is wrong to call debtors as your assets, because in the current assets, we've changed it. We no more say debtors in current assets when we are doing the statement of financial position. We rather say trade receivables, because the debtor is the human being or the organization, and the human being cannot be your asset. But the money of yours with the person is your asset. And that money that is with your that money of yours that is with the person will rather be called receivables and not debtors. And so let us shun the use of debtors as assets. However, it doesn't also mean that we have completely written off the term debtors from our financial statement, or let's say from our accounting knowledge. Okay, the debtor as a concept or principle still exists. The debtor is a customer that has bought on credit that owes you the business. Receivables refers to the money that the person is owing you. So they all have their place and they are still in use, both of them. It's just that on the face of the financial statement, if you are listing your your current assets, you do not list a debtor as an asset. You rather list receivables. Most of the questions that we solve, because of what we have been doing in the past, most of the curriculum has not been changed in our various schools. And so it's likely that even as I'm speaking to you now, you may be solving a question, or you see a question and you are going to still see debtors classified as an asset. Well, that is what we used to do before we changed to receivables. And so in your mind, you should understand that going forward, you should stop writing debtors as an asset, but you rather write your receivables as assets. And that is what we are going to work on. The topic that we are going to handle is about debtors and receivables. And so I just want you to understand that we may prepare debtors account. That one is still accepted. Okay, a debtors account is a personal account. It's the account of the person. We don't open receivables account. We open the debtors account. But the money with the person is called receivables. You should try and understand that. But then what we are going to do is that we are going to look at receivables, the amount of money that they owe us. That is what we are going to talk about under this topic. Now, when someone is owing you, there is always a probability that you may or may not get the money back. There is always a probability. There is no 100% assurance that if someone buys from you on credit and promises to pay in the future, the person will always redeem the promise. No. It is likely that for your numerous debtors that you have and for the total amount of money that you have on the face of your financial statement for receivables, some part may not be paid, or one or two debtors may not pay their money. Now, if it becomes certain that a particular debtor will not pay for reasons that are beyond our control and that the money will never be retrieved, for example, the person is dead and there were no agreements to take from a third party or any other person, and we are sure that this money cannot be retrieved from the person, then that money or that portion of the receivables will be called bad debt, because it is a debt that they owe us. Okay, and now it is sure that we cannot collect it, we cannot recover. That is why we call it irrecoverable debt. We cannot recover it again. We cannot recover. And so that brings us to the concept of bad debt. Bad or irrecoverable debt. And irrecoverable debt is a debt that is, should I say, not collectible. You cannot collect it. A debt that cannot be recovered from the debtor. Okay, so it is going to affect the total receivables. It's going to affect total receivables by reducing the value of this. And this irrecoverable debt will end up as an expense in the statement of income, because once we have lost that money, it is going against our profits, because we sold goods we were expecting to make profit. As a matter of fact, the credit sales that we made to the person is part of our sales figure on the income statement as revenue. So we expect that portion to arrive at a profit. But the moment the debtor, it becomes certain that the debtor is not going to pay, then that money that has become a bad debt or irrecoverable debt must be treated as an expense in the income statement, so that it will reduce the expectation of the profit. That is the meaning on how to treat this. And this will be subtracted from the receivables figure. For example, if you have receivables, total receivables of $1,000, and it becomes certain that $200 of them is irrecoverable, then of course, when you are going to prepare your statement of financial position and you get to current assets, you cannot pick this 1,000 again as your current asset. You will be overstating your asset. You have to reduce it by this, and you are going to get a balance of $800. This is going to be your net receivables, and this is receivables that you have already adjusted your bad debt or irrecoverable debt. And so irrecoverable debt has a tendency of affecting the receivables total figure that is being taken to the statement of financial position. And then also, it's also going to be treated as an expense in the income statement, or what we call the profit or loss account. It's going to be treated as an expense. So that is how to deal with irrecoverable debt. Okay, now, this thing that I'm doing this adjustment in the assumption that there was no double entry passed for the irrecoverable debt. If the double entry was passed for irrecoverable debt, the double entry for bad debt is that you are going to, this is an expense, I told you. So you are going to debit the bad debt account. We debit all expenses anyway. And then you are going to credit the debtors account to reduce the receivables figure. And once you are crediting debtors, you are reducing. So what I've done is more like a double entry. So this is how it's going to be. You have a bad debt account, and then you have a debtors account. Now, you are going to debit the bad debt account with $200 in the name of debtors. And then you are going to credit the debtors account in the name of bad debts, or irrecoverable debt, $200. This is how the entries is going to be. Originally, there is a balance brought forward of $1,000, so that the balance carried down on this account will be $800, and that this one will be transferred to the income statement as an expense. And so at the end of the year, we are going to close this account by transferring this $200 to the income statement. You can either call it income statement or profit or loss, and then you just close it off. So this is how we are going to close off the bad debt account. So at the end of every period, bad debt will be closed to the income statement as an expense. That is the meaning. And once we are crediting bad debt account to the income statement or P&L, then it means that the corresponding entry is going to the debit side of the P&L account. And so that means it will end up as an expense. So this, we should take note of this, because after my explanations, we are going to take a question and then try and do the double entry for bad debt account, and then we'll also look at the provision for doubtful debt account. And so for the bad debt account, this is how the double entry is going to be made. You debit your bad debt, you credit your debtors account. Now, if you are asked to prepare debtors account, this is how you are going to go by this. But if you've not been asked to prepare the debtors account, then you just do this for your bad debt account. All right, so please, this is how we go about this. Okay, now let us quickly move on to provision for doubtful debt, or provision for bad debt, or allowances for receivables, whatever you want to call it for now. Let us look at that as well. Now, the next thing we are going to look at is the provisions for doubtful debts, even though you may see it as provision for bad debt in some cases, but it is provision for doubtful debts, which we call allowances for receivables that are not likely to be paid. That is the meaning. Now, as the name suggests, it's called doubtful debts. These are debts or part of the receivables that we think that they may not pay. Okay, so it is not certain yet that they are bad debts or irrecoverable, no, but we are only doubting that this group of debtors or this very debtor may not pay, and so because of that we say it's doubtful debt. Now, usually when we are not sure of who it is, but we want to make a general assumption that, okay, let us assume, in response to the prudence concept, let us assume that 10% of our debtors may not pay because we are expecting possible future losses instead of a profit. And so when that happens, if you have receivables of, let's say, $1,000, like I said, and you are supposed to make a provision of 10%, then it means that you are going to calculate 10% on the 1,000. You are going to have 100 as your provision. Now, this is the meaning. Provision is a charge that is made against profit for any possible known cost that is ahead. So if you have made this $100 provision, then it means that even though you know that you have receivables of 1,000, yet you are expecting that $100 will not be collected. So you, in effect, you have only 900 that you are sure that you are going to get. Now, according to the prudence concept, you are supposed to maintain only the difference, the 900, in your statement of financial position as a current asset, even though nobody has told you they will not pay. Okay, so we are going to expense this 100. This provision for doubtful debts of 100 is also going to be treated as an expense to reduce our profit. Then, when we take this out in the statement of financial position, when we have the current assets, receivables, we are going to subtract this 100 from the receivables figure, and that is going to give us a difference of $900 as the balance for trade receivables in the statement of financial position. Now, let me also come in. Now, imagine or assuming that we had bad debt of $200, like I told you, bad debt, and now we have a provision for doubtful debt or allowance of 10%. So we are having $200 for bad debt, and then we have $100 for a provision. Then it means that both of them are going to be expensed. And so we are going to take this 200 as bad debt expense. We are going to take this 100 as expense for provision for doubtful debt or allowance for receivables. And both of them is going to be subtracted from the actual receivables figure in the statement of financial position. So in effect, in your statement of financial position under current assets, you are going to have trade receivables $1,000 less bad debt of 200 and less provision of 100, so that in effect you have only 700 as your trade receivables figure. And you see, even though we all know in our books we have 1,000 that we are expecting to receive, however, we are only estimating that $100 may not be collected. As for these 200, we are certain they will not pay. But this 100, we are only making a provision so that if in case they don't come and pay, we don't have any problem. We are okay because we have already made a provision against that. We are not caught up by the surprise. But if they come and pay, then it becomes a profit for us because we didn't expect and we have gotten it. So that is the prudence concept. That is what it's all about. So we are going to do this. Now take note that as for the provision for doubtful debt, it is always made at the end of the year when we are doing our final accounts. And therefore, this 100 will always be reduced or subtracted from the receivables figure. But this 200, that is where the issue or the question comes in. If it has already gone through the double entry system, we know that the double entry for bad debt is you debit your bad debt account or irrecoverable debt account, and then you credit the debtors account. So if you have already done that, then it means that the final figures on the trial balance, after the double entry, we extract the trial balance. And the trial balance is what we are going to use to prepare our final account. And so if you have already gone through the double entry with the bad debt, then it means that the final bad debt figure on the trial balance has already gone through the double entry. So that is the final figure. And that also means that the receivables figure there is also the final balance, which has already been adjusted of the bad debt. And that means that because you have already done the double entry and subtracted the bad debt from the T account, you are not going to subtract the bad debt again from the statement of financial position. And therefore, if you are doing final account and you see bad debt in the trial balance, it has already gone through the double entry system. So you only expenses, you don't come and take it from the statement of financial position where we have the receivables. But if it has not been taken through the double entry, and that is when it is in the adjustment or the footnote, that one, then you can now complete your double entry by taking it as expense and bringing it here again to subtract. So you need to be careful. If you want to get more enlightenment on this, go back and watch the videos on adjustment for final account. I spoke extensively on some of these things. Okay, so that is that for the provision. So please, that is it. But I want to focus on something more than what we are just doing, the double entry for provision. That is my focus for today. We are going to look at the double entry for provision for doubtful debt or allowance for receivables. Now take note, when it comes to the issues of provision for doubtful debt, it is quite different from the way we treat the bad debt, in a sense that over here, because it's just an estimate with percentages, because it's just an estimate, we are going to be focused on the increase and decrease year after year. In the first year that you are creating provision, all the total provision that you get in terms of the monetary value will go as an expense. So let us assume that we have 1,000 as our receivables figure, and then we are told that provision for this year, maybe 2019, provision for doubtful debt is to be 5% on debtors figure, on receivables. Sorry. Now take note. You are going to calculate 5% on the 1,000 as your provision. And so it's going to be $50. Okay, so in 2019, we are going to have 5% of 1,000, which is going to be $50. This is going to be our provision for doubtful debt. Now, we are going to take this $50 to our expense in the income statement or the profit and loss account. This $50 is going to be an expense for provision for doubtful debt or allowance for receivables, because this is the first year that we are creating. Subsequent years, in 2020, which is the next year, if we should calculate the same 5% on whatever figure, it may be a different receivables in that year. Okay, so let us assume that in 2020 the receivables figure was 1,200. Okay, for 2020. This one, all this is for 2019. So in 2020, receivables figure is 1,200, and we are supposed to calculate the same provision of the same 5% on 1,200. You see that 5% on 1,200 is going to give us $60. So in 2019, which was the first year of creating provision, we had $50 and that went as an expense. In 2020, we are going to have $60. Now, this is supposed to be an expense, but this is where the issue comes in of increase and decrease. We are not interested in the absolute figure that we had for the year. We are only interested in the difference when it comes to the profit and loss account or the income statement. And so, when it is increasing, here we can say that comparing with last year's provision, the allowance for receivables has increased by $10. And the increase of $10 only is what is going to be taken as an expense. However, when we get to the incomes, the statement of financial position, we are going to subtract this whole 60 from the current asset. Let me illustrate it well for you. So let me do this. In 2019, okay, this whole 50 is going as an expense. But when we get to the current assets in the statement of financial position, we are going to have receivables of 1,000 minus the 50, and that is going to give us a final receivables figure of $950. Now in 2020, under the same current asset, we are going to have receivables of 1,200. The figure that we had for 2020 is 60, so we are going to take 60, and that is going to give us 1,140. Okay, so what I mean is that in the statement of financial position, whatever figure that you have, the full figure that you had for the year, will be subtracted from the receivables figure in the current asset. There is nothing that is being done about it. But when it comes to the income statement, the profit or loss account, that is where we do the comparison. So the comparison of the figures that I'm doing does not affect in any way the statement of financial position. The statement of financial position, where we record the actual receivables figure under the current asset, will always take the full figure that was calculated for the year and we subtract it from the figure. Every year is a full figure that we are going to subtract from the actual receivables figure that we have left. Okay, but when it comes to the income statement, it's going to be different. So whatever thing I'm going to teach you now, the focus is more on how to treat it in the income statement. As for the statement of financial position, I think there is no problem with that, because whatever figure you have for the year, you subtract. But let's look at the income statement. When we get to the income statement, like I told you, 2019, it was the first year that we created provision. In 2018, let's assume there was no provision. And once it is your first year of creating provision, then you are going to take the full 50 as an expense. Because let us assume that 2018, the figure was 0. We had 0 for provision. In 2019, we had 50. What is the difference between 0 and 50? The difference is 50. And so in 2019, we are going to take 50 as an expense. That is the difference between the 2 years. That is why I'm saying that if it is your first year, the difference will automatically be what you had. Then in 2020, we calculated and we had 60. What is the difference between 50 and 60? It is 10. So in 2020, we are going to take only 10 as an expense. That is the meaning. In 2021, if you calculate and let's say you have 100, the difference is between 60 and 100 is 40. So you are going to take only 40 as an expense. That is what I mean. So with a provision for doubtful debt, when it is, we only take the increase as an expense. I know you may be asking yourself, what if it's a decrease? I'm coming to the decrease. But I just want you to appreciate the fact that when it comes to the income statement or the profit or loss account, when it's provision for doubtful debt, we are interested in the difference only and not any other thing. Then let's assume in 2022, you calculated your provision for doubtful debt and you had 75. Now, comparing this to the previous year, there has been a decrease of 25. So this decrease of 25 will not go as an expense. It will rather go as other income. It's an income. So when provision for doubtful debt is increasing, it is an expense. When it is decreasing, it is an income. I know we have done these things with adjustment on final account. But in this topic, what we are doing is that I want you to understand it, because we are going to solve questions where it is not final account. If there will be anything, it will be an extract. But what we are going to do is that we are going to open T accounts for double entry, for bad debt account, and for provision for doubtful debt account. And that is what I want us to do. So when it is increasing, you will see that we are taking the difference to the profit and loss account or income statement as an expense. But you will see that when it's a decrease, it's going to rather be an income. And that means that this 25 will not be an expense, it will be an income. That is how we go about that. And so if in 2023 it increases again to, let's say, 85, then you compare with the 75, then the 10 will be an expense. So that is how it's always compared to the previous year's provision. That is why when you are doing final account, you see that on the trial balance there is provision for doubtful debt in the trial balance. Then in additional information, they will give you something about provision. When you calculate what is in the trial balance is supposed to be last year's provision. What you had from the footnote is this year's provision. So what do? Compare and take the difference as an expense. But remember that whatever you had for this year, the full figure will be taken to the statement of financial position and reduced from your receivables figure. So that is very, very dynamic. So I'm sure you've understood this. We are going to take a question and I'm going to use it to prepare these two accounts for you. Then after that, I'm going to explain something called provision for discount on debtors, which we can also call provision for discount allowed. And I'm going to talk about that, and we are going to take a question relating to that. And in all these things, we are going to look at the income statement extract and the statement of financial position extract, where we can show how they will appear over there in those statements. But remember that the provision for discount on creditors does not exist. That is provision for discount received. Provision for discount received will violate the prudence concept. It's an anticipation of profit, and therefore we are not going to talk about that. Okay. So I'm going to solve a question shortly in the part 2 of this video that is just following. Remember to subscribe to this channel, share this video, and let others also have a benefit. I told you, and I've told you times before, that we are going to be successful together and we are going to grow together. Until we meet again for the part 2, it is bye for now.